I want to get back to the importance of focus because I think that that is something that a lot of new investors struggle with. And then even experienced investors, they sometimes struggle with it, right? They become a symptom of their own success and they start to spread themselves thin across markets, asset classes, et cetera.
Someone gave me great advice early on. Hone down and be very specific with what you're looking for. Because usually the rebuttal to that is that, well, I'm going to miss out on a ton of opportunities. But my response to that is, well, you won't know what you're looking for if the opportunity is right in front of your nose.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. And this episode, I'm chatting with Jason Yarusi of Yarusi Holdings. Jason's an extremely experienced multifamily investor and entrepreneur, somebody who got to start back in the early 2000s in the nightlife industry in New York City. You learn what took him out of that business, which is it's an interesting story. And that said, he did go on to start a brewery, multiple restaurants, which led to him joining his family's construction company when Hurricane Sandy hit the New Jersey, New York area. Helped his family build that into a sizable business. And then we learned how he ended up getting into multifamily real estate back in 2017. And since 2017, him and his team have bought over 3,000 units of multifamily real estate throughout a handful of different markets, including Kentucky, Tennessee, some other southeastern markets as well. And I think it's important to note that Jason's an operator of real estate. They brought their property management in-house a few years ago. And he's a real operator, right? They're buying the deals, or I should say, they are buying deals and raising capital for deals that they are actually the operator of. He's not just a capital raiser for a bunch of other people's deals, which I think is an important distinction when you start talking about a 3,000 unit portfolio. And in this episode, we dive into a whole bunch of different topics. We talk about how to think about market selection. We talk about the importance of focus when you're getting your business off the ground, both in market focus and actual acquisition criteria focus and product type focus. We talk about how to be a great asset manager, how to asset manage your properties really well. And we talk about what he's seeing in the market today, both specific to his backyard market of Tennessee, as well as some of the other markets that they're buying in as it relates to distress and trends they're noticing and how he's thinking about making investment decisions today. So great episode with Jason here. Be sure to stick around and give the whole thing a listen. And if you haven't already, please consider leaving the podcast a rating and review. Helps the show get noticed by more folks, as you hear me talking about each week. We are coming up on 300 reviews, at least on iTunes. So if you've learned anything, take 2 seconds, just leave a 5-star review. I'm hoping to get to 300 before we get to 300 episodes. A little bit of a internal goal of ours here on the Multifamily Wealth Podcast team. So if you could take 2 seconds, if you haven't already, and leave that review/rating, that'd be much appreciated. But without further ado, let's get to my conversation with Jason Yarusi. I'm here with Jason Yarusi. As you just heard me kind of run through here, hell of a background, thousands of multifamily units, interest in other businesses outside of real estate. Just an overall impressive guy. He's running a ton of miles as well. Maybe we get into that. But let's get into it here, Jason. Why don't you share a little bit more about your backstory? Talk about how maybe you found the real estate business and what your business looks like today.
When I was younger, my dad always would just talk about real estate. But when you talk about real estate, it's just like this big blue ocean of just a million different things you could do. It was, you have to get in real estate. When people are successful, they're in real estate. And he always had just talked about it, but he never did it, right? He had a small construction business. That was his focus. That's where he went for many years. And because of how I saw my dad struggle with those points, I went a different path, right? I went to school, was kind of lost where I wanted to go in school. I left college with a business degree, but didn't really want to focus on business. So I did, which was the next natural step. I started working in bars and restaurants in New York City, right? So I started doing that and was not very fulfilled in the steps I was taking, right? So I did, but I constantly did it, right? Many times we repeat these things that you don't like doing, but you say, well, this is what I'm doing, so I might as well just keep doing it, right? Until you start figuring out something of another avenue to go. But I was in this pace where I was just stuck in this rhythm where I was just repeating the same thing over and over and over again. And one night about 3 a.m, I left the bar I was working at. I was riding on my bike back to my apartment. I got hit by a car. Got a pin in my wrist. I had a broken bone in my shoulder, a bunch of stitches in my face, my head. I still have scars today, right? And I get out of the hospital and I'm thinking, man, I need to get back to work because I needed to make money for rent. And I was like, okay, hold on. That's a crazy thought because all I'm doing is complaining about where I am. I don't like what I'm doing. I don't like anything about my situation. And now I get hit by a car, blessed I'm not hurt further. And I just want to get back to doing the exact same thing. And I was like, okay, I have to either just say to myself, I'm good. I'm going to stop complaining and just deal with where I am and just settle like, okay, this is what I'm doing. Or I have to do something different. And, many times we get stuck in this pattern where we want to do something different, but you just don't know what to do. And I was in that spot, right? Like, I have to do something different. What do I do? I just started literally doing the opposite, right? Get up earlier, stop staying up at night drinking, start to have like a dedicated workout plan, start to do these things. And lo and behold, it wasn't like this magical transformation overnight. Like yesterday I was this guy and today I'm this brand new guy. But things started to look up because I started to put positivity in my mind, right? Because sometimes we look closed-ended in our mind and our focus is just so narrowed that we're just saying everything is, woe is me. I'm like Eeyore from like Winnie the Pooh. I'm like, everything is the worst thing, right? So I just started to look for things that would just make my day better. And through there, I went from working behind a bar to opening a bar and restaurant in New York City. I opened this sort of brewery in New York City. And then lo and behold, a big hurricane happened on the East Coast, Hurricane Sandy. And my dad's small construction business was really focused on things that would help like foundation problems or lifting or moving homes. And so his business exploded overnight. So at the time, my now wife, Peely, was, my girlfriend at the time, my little brother who was working for me in New York City. We moved out to New Jersey and helped dad really scale his construction business. But throughout that process, we were just so busy just doing actions, right? If you're serving a beer or you're out there doing construction, if you're so busy in the work, right, there's only so many hours in a day. And at a certain point, if there was 25 hours in a day, 8 days a week, we've been using them because the more time, it wasn't being more productive time. So the question kept coming up, like, what are we going to do to get back to a place where we can just control our day? Peely was pregnant with our first kid, and we were just looking at this as like, we have to do something different. Again, that word came up. And the thing that popped back into the conversation was real estate. So we started to just really focus on learning, like what do people do out there that are successful in real estate? And quickest thing is that what's in come in front of you is flipping homes. So we started to do very big construction projects. We were lifting homes, adding square footage, just very, very big project, right? And those were good, but we were so busy in the weeds again because we were doing all these things, running to Home Depot, meeting the contractors. And so going well, okay, fine. That's not completely the answer. What do we do? So we started wholesaling, started to do some out-of-state rentals, and lo and behold, the out-of-state rentals started to produce, we'll say, money that would come to us without us physically doing the work because I was forced to just understand the area, understand the obligation, understand how to put together teams, put together processes, put together the entire plan. And through that, we came upon a podcast like this where someone was talking about buying apartment buildings. I was looking at it, buying 2 families or 3 families. It just wasn't this magical scale that you could get, right? I had small restaurants and big restaurants, and it's been pretty much the big same process. So I was looking at real estate and I was saying, well, these 2 and 3 families, they're fine. They're doing okay, but it doesn't seem like this thing you could really grow at a mass pace. Came upon someone who was buying apartment buildings, and lo and behold, it was just a method and a model that really stuck with me and really stood out to me. So we dove in just to really understand the entire format of how that business worked. Funny enough, there was a guy who lived about a mile from me that, I was in New Jersey at the time that owned something like 5,000 units. It was like Denver and San Antonio. He'd been doing it for decades, right? Found him just out of the blue, went down and talked to him, just started talking to people, just really learn the method, the model, the processes before learning and diving into where I wanted to go. And then we started putting the work in. Found that the market we wanted to start in, which was Louisville, Kentucky, and ended up buying a 94 unit. And that was first of about 500 units there. And now we're about 3,500 units in aggregate down here, mainly in the Southeast.
Love it. I mean, that's a hell of a story. I'm trying to think about how far back I want to go. Kind of real estate operator in me wants to talk about the construction business, but I think obviously the folks listening want to hear about how you kind of got off the ground early. So maybe we'll start there. That first deal that you did in Louisville, I guess this is going to be a multi-part question here. One, why Louisville? What drew you to that market? What were, whether it was metrics, team, whatever, why there? And then what about that first deal? Let's talk about that first deal in terms of like, why did you end up pulling the trigger on that first deal? What were some of the attributes of it that made you feel comfortable with, all right, here we go, earnest money deposit, we're buying this, we're jumping in, et cetera?
I had someone on my Live 100 podcast the other day that was talking about goals, right? And being very specific with what you want. Because sometimes, like, imagine you were like, hey, I want to go on vacation. Well, where are you going to go on vacation? I don't know. It's going to be somewhere good. Okay, well, where's that going to be? Well, it's going to be fun. Well, it's going to be magical, right? And that's how sometimes we treat our goals, right? Like, we don't have a specific goal in mind. And someone gave me great advice early on. Hone down and be very specific with what you're looking for. Because usually the response to that, right, or the rebuttal to that is that, well, I'm going to miss out on a ton of opportunities. But my response to that is, well, you won't know what you're looking for if the opportunity is right in front of your nose. And so I started looking for very specific things, right, and very specific markets. And I honed down to Greensboro, North Carolina, and Louisville, Kentucky. because I was looking at just everything from population growth, job diversity, red states, all these different parts of just the number of businesses that are moving in there, landlord friendly, the type of apartments that were this, like a big focus on workforce housing. So what existed there, right? I was looking at all those things that stood out. And for a market that wasn't truly just appreciation and wasn't truly just cash flow. And so both those markets touched on it. Went down to Greensboro. We're really focused on there, really hitting it. And we're putting out offers. We're feeling good with what we were doing, but just wasn't hitting the mold, right? Just wasn't getting anything that was actually accepted. And so instead of, we gave it a couple months. And that's something I say to people, you got to give time in the market. But what we did there is we learned the process. I learned how to find brokers. I learned how to talk to bankers. I learned how to just go and interview property managers. I learned how to do all of the groundwork to have the process prepared, because you have your internal partners, right? Which might be you and yourself, right? And the first one was me and my wife, right? Asset management, due diligence, lead generation, underwriting, balance sheet, right? Investor relations, right? That's like your internal team, whether it's you or others. And then you have your external team, right? That can be everybody from your construction partners, your bankers, your lenders, your insurance people, your property managers, right? Those are typically going to be people outside yourself. But you have to find those people in your network because they can be very useful. And so we would find one we like and then ask for referrals and others and just continue to interview them to put us in the right spot. Did all that in Greensboro, weren't hitting the mark, and decided to make the move to Louisville. I had been to Louisville a little bit, even though I was still in New Jersey. My sister was the only smart one in our family who left New Jersey early after school and moved to Kentucky. She was in Louisville, right? So I knew enough, but I ended up making myself so conditioned on the market that I knew the city better than her, right? She could tell me where every hot restaurant was or all the other spots, but I could tell you, okay, these are the submarkets I want to be in. I wanted to be in the South and South Central submarkets. That's where all the workforce housing was. That's where it was. And if you looked at it, they have GE, they have UPS, they have Humana, they have Aetna, which was purchased by this. They have the Yum brands, they have Churchill Downs, right? The Yum Center, right? What am I forgetting? The Amazon plant right there. So they had all these different drivers bringing workforce in. It was 2 or 3% population growth year in, year out. Nothing big, nothing small. Massive amount of jobs we just mentioned, job diversity, right? And then it had a very big supply of workforce housing. And in the submarkets we were focusing on, there was no new construction plan till we brought this property in 2017. It was like 2022, right? So there was nothing coming online to really be competitive. So we started really honing in with a focus that we wanted to buy a 75 to 125 unit building, BC asset built between 1970 and 2000. At that time, it was something crazy. It was like between like 3 and 7 million, right? Like of what the purchase price was. And that was our avatar, right? That was the thing we were looking at. So we just started telling everybody. But at the same time, we started to go out to talk to investors. And I made a one pager being like, hey, I'm looking at this space. This is what I'm interested in. This is why I like multifamily. This is why I'm using syndication. This is how the project's going to be structured. This is how it works. And for my network, right? Remember, I have a lot of friends and family who had never heard of this before and who were just, they've seen me in other spaces, construction, restaurants, all different things that weren't real estate. It allowed me to condition them and explain to them so they could have time to understand the opportunity. But on the other end, it gave me the bandwidth to get, we'll say, soft commitments. We weren't asking for money at the time, but we were saying, okay, when I find this, right? Like when I find this project, would you be interested? And if so, how much? And we raised about $1 million at the time of people who were committed to the idea when we found the actual idea or actual project. So lo and behold, we came across a property that was through a referral through a property management company that we liked there. It was off market because the father had passed away and the kids who were like in their 50s and 60s ended up taking over the building. They lived out of state and they're like, we don't know, what are we doing with this thing, right? So they had some crazy thought in mind about how much it was going to cost or what purchase price they wanted to sell it at. And it was, I think at the time, it was like $3.2 million and we offered $2 million. Like it was a very low part, right? But my numbers made sense and that's why I offered it. It wasn't like, let me just go lowball. I'm like, that's what made sense for how they were operating the property because they weren't really operating it. They were like 1,000 miles away trying to operate it, just like throwing things at the window. So they said, no, thank you. I think they countered back at exactly their asking price, like 3.2. I was like, well, that's not much of a negotiation. So I appreciate it. And we went off and just started looking at other opportunities. Well, lo and behold, like 4 or 5, maybe 6 months went by. I was tracking all the projects they were on, and I went back and said, let me just go see what happened. And nothing had happened with that property. Made another offer. I think we came up like $100,000. And within like 3 hours, we had a counter at like 2.6. So, like 4, 5, 6 months, They went from 3.2 to 2.6, and we were from 2 million to like 2.1, I think, right? Well, we negotiated back out, and within whatever was the time in between, 3 weeks, 4 weeks, negotiated down. I think we closed like 2.2. And so we got that project across the board, but we got agency loan at the time. And I also had the investors that I went back to and said, hey, here's the project that I've been talking about that we're going to find. And we didn't raise the money in a day, but we basically had the commitments in a day because we had done all the pre-work for months to find ourselves into that opportunity.
Man, that's a great story. And there's a couple things I want to highlight here. I want to get back to the importance of focus because I think that that is something that a lot of new investors struggle with. And then even experienced investors, they sometimes struggle with it, right? They become a symptom of their own success and they start to spread themselves thin across markets, asset classes, et cetera. But we'll come back to that. I think what you just described as the story around how that deal came to be is such a similar dynamic to what's happening today, right? We're recording this late August 2025, where seller has price in mind today, but then over a period of time, motivation starts to build or increase, whether that's operational, maybe challenges at the property, especially in, Texas, Southeast, Southwest markets. I think that's a little bit more of a prevalent story right now than, Northeast, right? I'm in the Northeast and a lot of the folks listening, are somewhere in the Northeast, right? And a little bit less distress here, just very broadly speaking, than a lot of folks who bought in Florida, Texas, some of these more high growth markets. But just because you're having a conversation today doesn't mean that the motivation on the seller side isn't going to change in 4, 5, 6 months. And I think kind of staying top of mind, staying around the hoop, whether it's a deal that's brokered and goes under contract, probably should be following up with that broker every 30, 60 days to see if that fell out of contract for financing or diligence reasons, whatever. Or if you're speaking directly with a seller, making sure that you're prioritizing follow-up right now. Because I think sellers' motivations are changing at a higher rate than they were when I think a lot of the people who are listening got into the business, right? 2019, 2021, where it was a little bit of a hotter market than it is now. But to come back to focus, because I think that's obviously a critical aspect of growing your business, especially early, right? I've always said on the show, lack of focus creates ambiguity around your business. Like narrow focus makes it much more clear for everyone in the marketplace to understand what you're looking for and to associate your acquisition criteria or whatever you're doing within the business with the opportunities that you're seeking, right? And the more narrow that criteria is or that focus is, the easier it is to communicate it to the folks who can bring you deals, bring you partners, bring you investors, bring you referrals, whatever it might be, whatever you're looking for. So with that being said, something that you mentioned as you were talking about kind of the journey was started in Louisville, got up to 500 units, I believe you mentioned in Louisville, and then started spreading kind of throughout maybe some other markets. I'm curious as to kind of what happened when you got to that 500 unit mark that maybe drew you to other markets, where you're saying, okay, we've got a base of properties. So we've got a portfolio in Louisville. We probably understand the market extremely well. We've probably got great relationships, but now let's start going into other markets. Was there a driving force behind that? Was it just the limitations of what Louisville had to offer in terms of how big you could grow? Or did you see some more opportunity maybe in the other markets that you decided to start buying it as well?
Great question. So, and to go on the point of follow-up, I believe, if I recall correctly, that we had made that offer at the time, our original offer. There was a few other groups that made similar kind of offers. But then everybody forgot about it, right? It became the project that was just way overpriced. And so nobody had followed up with that seller. And we just by happenstance did, right? And that was the big delineating factor at the time. So Louisville, we ended up selling that project in about, was it like 32 months, if I recall. We did a cash out refinance after like 12 or 13 months, got out about 80% of capital, and then exited, just got a really crazy offer. And so just exited a really, great return, super first deal, right? But we had worked on that one for about 12, 13 months just to make sure the business plan was exactly how we modeled it before we went out there for other opportunities. But then we did start looking around Louisville, same submarkets, same identifiers, right? And get that focus of what we were buying. And we continued to acquire there. What happened was the onset of COVID created some narratives that were interested there that I wasn't a fan of. One, they just were offering assistance money till the end of time, right? So renters knew that we're in workforce housing. If they didn't pay, they would, could drag it out. They would get to court. At the court, they would say they're going to go for assistance money, and then the judge would give them time to get to assistance money. So you have a select amount of tenants. That was one piece. The other problem was the labor market. We had a property management company that we used and they did well. But the labor market, because they kept offering all this free money, we were offering maintenance guys like beyond aggressive salaries plus bonuses. It was like they were like working in tech, trying to get a maintenance guy, and you couldn't even keep them on the property. And I
I hear
was
you.
hearing this
Yeah.
systemic across the area. It was just a very interesting time. And then the last piece was the management company I had. It was two different partners. They got in a big internal dispute between them and split up, and that started creating some disruptions in terms of our operations. So we ended up moving to a different management company while we were doing this, and then when we started selling off some of those assets, got under a certain part, we had to move to a third because it got, I think the last one we had was 65 units, right? And it was just too small for the larger groups that we had on site. So we started to go and sell, plus we had really got ahead of the business plan on those. So we were doing very well. So it was just a good time to sell. So we sold out of all those properties and then started looking into other markets, right? And then the natural market, we started moving down towards Nashville, right? A lot of energy into Nashville. We ended up moving down here just south of Nashville ourselves and started buying there with this similar context, right? So we do still today have a very similar business plan. About 95% of our opportunities and our investments are garden style, workforce housing, multifamily properties. We have 5% that's everything from self-storage. We have an office building and we have development that's mainly here in our backyard.
That makes a ton of sense. And then, I mean, personally moving to the market is huge as well, right? I mean, that makes it far easier to actually find deals, build the relationships with brokers, meet
Yeah.
the investors. Investors can go out there and actually see what they're investing in if they're people that
Yeah,
are
because where
closer
are
to
you?
you.
Where are you? Where do you live?
Yeah, so I live in Boston,
Yeah,
and our
okay.
real
Yeah,
estate
so
business operates in New
yeah,
Hampshire, right? So an hour north of Boston, right?
got it.
And my thing, whenever I'm chatting with somebody and they're talking about, hey, what market should I invest in? I mean, I say a lot of the same things you said. That's so vague. Like we got to start to try to narrow this down a little bit.
Yeah,
But with that being said, the easiest place to buy is close to home. Like it'll always be easier to
100%.
find a good deal close to home. And maybe if you live in downtown Manhattan, like, okay, maybe that's not an option, right? But you should, if there's any opportunity that align with your goals within an hour and a half drive of where you live, like that's probably going to be your best bet because the value of actually sitting down with a broker over lunch is entirely different than just doing Zoom calls and
All
phone
day.
calls.
Yeah, New
Well,
Jersey with very similar things. It was like, okay,
yeah.
infrastructure's, permanently old, right? Taxes are high, insurance is high. Your price per pound doesn't go very far for us here, right? So you buy a unit for 175 or 200K and you get, $900 of rent or $1,000 of rent. Like the overall metrics and just the analysis was very hard. You're basically just banking on appreciation. And that's why we started looking outside New Jersey beyond the part of just all the, we'll say, government actions in there that make it a very tenant-friendly state.
Yeah, same exact thing with Boston, right? New Hampshire being it's surrounded by a bunch of extremely tenant-friendly states. New Hampshire is actually pretty landlord-friendly. Now I'm putting my pitch New Hampshire hat on here, but it's the same concept, right? For a lot of the same reasons. We're like, we got to get up over the border there. It's an hour away. It's still close enough to be what I would define as like my local market.
Right.
Now, in terms of continuing to grow the business, right? So we got up to 500 in Louisville, sold them out. Now we're down in Nashville buying. Let's assume we're building a large portfolio in Nashville. I'm going to make the assumption still third-party management, or did you bring that in-house, or was it still continue to work with third party?
So at a certain point, we found because we started acquiring some smaller properties, right? And where I found is the threshold is that you can find great property management companies of all sizes, right? But they have to be specialized, right? Because usually
Yeah.
what you'll find, like even the 65 unit, we're having a hard time for that one because you would get in a bunch of like single family groups. Like, yeah, we manage 300 houses. We could figure that one out. And we're like, well, we don't want to be the figure out company, group, right?
Yeah.
We want the group that can come in and manage it. So we had a number of properties that we were doing more time managing the manager than actually just having the manager do the investment. And so there was I think 22, maybe 2022, we opened out in-house property management. So we don't manage all the properties here. So we manage close to about 900, if that's right, about out of this office. And then the others are managed by third-party management companies in those select markets. I did not position it as I wanted to do management, but I found that we were doing better for ourselves, doing better for our investors, doing better for the projects by just truly taking it on, cutting out the middle. Because on a small property, I get it, right? You can't have on-site from those. They have to have a lot of scalability for those type of property management companies. So they need to have a lot of properties, right? But they can't have the back end to support them, right? And so you're not having the full focus because it's you and 50 other owners across those fourplexes, 20 plexes, like 36 units, right? Those are various owners that have to go to the same person who might be you will say the regional for 200 property or 200 units, but that 200 units is split up on like, 50 properties. So we started to say, okay, what do we have to do? And so my first hire was to bring it in where I'd have someone help with leasing, right? Leasing and collections. Then we started to figure out how to do the maintenance side. So we started to navigate that because that was a conversation in the beginning, is that you can, as we said, the internal team, right? You can either partner with people, right? Or you can start to bring people onto your team.
Yep.
And both have, great, both can be great, right? But we started going into the model of bringing people onto our team and hiring people. So, we have a full office now. I have one partner that we partner. He's the other side of this office that we partner on pretty much all of our projects here in Tennessee. And so we run the property management company out of here and then also our investment firm out of here.
I love that. Yeah, I think a lot of people get to that stage, especially if you're buying kind of mid-sized deals, right? Which we'll loosely define as 25 to 75 units, different in different markets. 75 units in Boston's a large multifamily project, but in, certain suburbs of Nat or Tennessee, I would say, or maybe around Nashville, it's probably not big enough to justify on-site management quite yet, right? And then you're kind of dealing with, you got to find someone who's going to manage that and 20 units up there and 5 units over there, and now they got a workload. It's really hard,
Those
I
are
think, to
hard
find.
sizes because like that
Yeah.
65, 75 is like, it's too big not to, but it's too small too. So you have
Yes.
to make what's the best for it. And usually you bring someone in because it's like, you can't just call in maintenance people all the time. You need to have someone there, right? Because the property's going to need it with that many size units, right? And the same thing from a leasing, right? It's like, okay, do we take a unit off and put a leasing person in there? So those are right in the sweet spot where you want to say, okay, can I pair this with another property, right? And use this as a centralized property here where I can have that 75 unit with another 50 unit, another 100 unit, something to make it centralized, right? Those are always the questions, but that's always a hard size to figure out what's the right play to do it.
100%. And it's interesting that does create some level of opportunity there as well, where, I think a lot of folks who have been in the business for a long time, have grown large portfolios, they start to just move away from those size deals because the management is harder to solve as you're describing, right? Unless they're
Mhm.
buying in a short period of time a number of these kind of mid-sized buildings in a particular area. But if you're going to bring it in-house and you have a little bit more control over prorating salaries across different properties, and it's a little bit easier to do that, it becomes a pretty big competitive advantage comparatively to the folks who just want to work with third party. Quick question on bringing it in-house, because I think this is interesting. We did the same thing in our business a little bit earlier than when you guys did, and if I were to go back and do it again, I would have waited. We brought it in-house at like 150 units, which we get like
Awesome.
one PM and like a part-time maintenance guy. But it would have been easier to bring it in when we had more, so that we could have afforded to hire more initially, and frankly, so that I spent less time in the PM business. But when you did bring it in-house, what were some challenges that you encountered that maybe you didn't anticipate when you decided mentally, hey, let's go bring management in-house?
Ideally it was that figure it out mode. So I guess the challenge is to make sure what you're missing, right? That's always hard, the hardest thing. What questions am I not asking? We had done it
Yeah.
enough for the property management company where we kind of turned around the narrative to ask ourselves the same questions, right? But then you have to look at, what are the state laws? What are the rules we need to abide by?
Yeah.
Make sure we're all in compliance with those rules. And then on site, the tenant practices, tenant laws, making sure we had the right lease in order. And luckily we've worked and work with some great management companies so we could hedge them. We would just go ask the questions, right? Because we were like, hey, where are you pulling your lease? Oh, we do, Blue Moon leases. Okay, great. And so what association do we need to sign up with to be able to get to Blue Moon leases, right? And so we just continue to say, okay, what's that next piece in front of me, right? Because usually with a lot of things, it can be prohibitive. You say, I don't want to do it because I don't know what to do, right? Well, you're never going to know what fully to do, right? But you have to understand that your value is in the questions you ask, not the answers you're seeking. You need to get the right question,
Yep.
right, to figure out what do I actually need to do. So we figure out, the schematics. Okay, so I have a building, right? Very simple. I have units. The units are going to need a couple things. You're going to need tenants, right? So they're going to need some form of leasing, some form of marketing, right? Which we were pretty confident in the marketing, right? The marketing side, but make sure we're leasing right, make sure we're modeling right and compared to the comparable properties, make sure. And we'd already done that pre-work because we were on the side of the asset management, right? And then look at maintenance. We have to find the right maintenance guy in there. So make sure that we're treating that in the right way, to how they're being paid, right? But a lot of this we would hedge on what's happening to market and then ask our friends who are property management, how are they treating certain things.
That makes a ton of sense. Let's talk about asset management here, because I think this is going to be a little bit more applicable to most of the folks listening. You mentioned you still work with some third-party management companies to manage the properties that you guys don't manage in-house. Very broad question here, but like asset management best practices in how you are actually managing the managers who are tactically managing the properties, like maybe some
Yeah.
processes, some systems you have in place, some things that you prioritize. I'll just kind of let you run with it in terms of
Sure.
how you actually arrange that within your business.
So weekly meetings, and that even goes for our team, right? We meet
Yep.
Monday about company-wide information just for the property management company. We meet Thursday on every property, right? But I do the same thing where we meet Thursdays for all of our other properties, right? And we have a weekly meeting, weekly reporting. In some instances, when you're beginning, it could even be daily reporting, right? Depending on just how involved the project is. At that meeting, we'll focus on leasing, collections, construction, and then open items. And those are usually your big pieces, right? So leasing, right, where we stand, what we need to do, that can incorporate marketing, could incorporate pricing, incorporate, anything with applications into collections, right? Where do we stand in terms of where we are in the books? What do we need to do to make sure that the property is performing at the level we want? Construction, and that could just be basic turns into, we're replacing roofs, just depending on whatever's the project. And then lastly is just open items. And this could be anything under the sun that's just an open item on the project.
Got it. And in terms of where you're identifying the most common problems, let's say when you're working with a third party management company, and I'm going to keep kind of specifying third party because I think that's a lot of the folks who listen. Where do you typically see third party management companies getting outside of how you'd like them to perform most frequently in the overall aspect of property management, right? As you mentioned a few things, we got construction, we got leasing, we got delinquency and collections, et cetera. Like, where do you find you're most often trying to bring them back into where you'd like them to be performing and coaching them? And do you do anything outside of maybe a weekly meeting to help try to drive that?
Yeah, we're active throughout the week, right? And so
Yeah.
there's a lot of layers here where these are not set it, forget it. But cost control is always a big thing, right? We want to make sure that we're within cost, right? And so make sure that what can happen over time is that, we've been using the same garbage contract or garbage company, so just let it renew, but we're not paying attention that the renewal just went up 40% just because that's their set renewal, right? And so you have to make sure they're tracking cost control, right? And then setting communication. You can't go in and change their whole philosophy. If they're
Yeah.
managing 10,000 units, you can't be say, oh, that's cool, but do it my way, right? Because they have all their philosophies, right? But you want to start set some guardrails for how you would like to see it in communication. Where I've seen people struggle with property management companies, it would be like, they're not doing what I want them to do. And I'm like, okay, well, what do you want them to do? They're like, this. Well, I was, okay, have you told them? They're like, no. We're like, well, how do you expect them to know what you want them to do? If,
Yeah.
like, well, they're doing this and like, because people think you get a property management company and then that's it, right? Then, check back in a month. Right. And that's not how the game works, right? You got to have a business plan. And when you're bringing on the property management, allow them to understand your business plan because a couple things can happen, right? They be say, okay, cool, let's run with it. But they could give you feedback in two other ways, right? The other way could be like, so we're in this market, here's all of our comps. That's not going to work. Right. And it could be anything. You're not going to go and be able to build back all these people for water because it's going to be not competitive with all the other properties around you. Or it could be, listen, we have these other things that we're doing, this select renovation or this select marketing or just fill in the blank. And it's producing this much more value to the property that you're missing out on here. Both of those can be great insight because one, you want to set them up for success too. I don't want to go in there and be like, hey, listen, don't renovate any units, but I want you to raise rents $500. So it's like, I want to make sure I'm setting expectations in a way that we can all perform well on the investment.
Yeah, absolutely. Let's talk about what's going on today, right? August 2025. Where are you pursuing deals? Why are you pursuing deals there? Maybe what are you seeing in those markets right now at this point in time? Maybe there's some comparison points to like today, this is happening more so than the last, few years, at least in terms of what we've noticed. But kind of pulse check. Obviously, you're a really active guy. You've got your hands on a whole bunch of different things here. What are you kind of seeing today and in regards to the deals you're looking at and the markets you're looking in?
So the last about 2.5 years, we've been really focused here in Middle Tennessee, just because we're here, right? We're local,
Yep.
and we've just been seeing the energy has not translated to what you see. Because remember, you can hear the words recession, but it's not nationwide, right? Every market reacts differently in a lot of ways. So if you have Nashville had a massive oversupply of units that came on from the holdup of COVID and then the onset of low interest rates, right? You had all this permits released, and then all these people wanted to build at the same time. So we had like 65,000 units come on, and it created this massive gap in absorption, right? So we had negative absorption absorption in Nashville for the better part of 18 months, where you would see new construction come on and try to keep the rates. So they would offer 4 months of free rent just to try to get someone in the door. And that started to trend down to Class B and Class C. So we saw that pressure there for a bit. But, 40 minutes away, I'm in Murfreesboro. Murfreesboro in the, not last year, but the 2 years before that was the third and 14th fastest growing city in the nation. And then it was like Florida, Texas, right? Like that, this city is growing tremendously. It's got 165,000 people of 250,000 people in a decade, right? So you look at this, like there's a lot happening here, and it's got all the same drivers in a very big fashion. Second biggest university in the state, very big medical field, all different kind of suppliers, warehouses, right? So all these things that are bringing people to this market. We had brought a property here in 2019. It performed really well for us and continues to perform really well for us. So we've been really focused on this area. Still love Nashville, and Nashville now has reverted where, Nashville has something like 108 people moving a day. And I think for like context, I think like Huntsville has like 8. It's like it's just like a massive amount of people that move in each day. So we're back into positive absorption. We knew it was going to come because now you've had this twist where everybody's saying, you know what, I'm not going to build right now. Let's wait to see, what things happening, because you still have high interest rates, you still have supply and demand constraints and labor, right? All these different puzzles that need to be solved. So we've seen that slow down a lot. So now rates are starting to trickle back up. So we're really bullish on this area, this whole corridor, everywhere from, Nashville down to Chattanooga.
Love it. Yeah. And I think it's one of those things where it's like if you've already got the infrastructure and you're already developed both internally in regards to like your own PM company and then the third parties that you clearly have a great relationship with because you continue to work with them, just pour gas on the fire that's close to home.
Yeah.
And it seems like, it's funny, like me being a Northeast guy, I mean, you probably still sense this dynamic in the Northeast, even though you don't invest up there, but it's just a supply constrained market, right? We did not see nearly the same volume of development as broadly speaking, Southeast Texas, Southwest, most of the Sun
It's
Belt.
hard to get out of the ground too, right?
Exactly.
It's like the logistics.
There's multiple
to get through
factors.
everything. Yeah, everything. Correct.
It's like cost to build, and then local government not being the most development friendly folks to work with. There hasn't been those growth metrics that have driven large scale developers to want to develop there comparatively to down in the Southeast, Southwest. So we've had much more resilient, kind of rent growth, even if we don't have rent growth in some of the markets we're buying, and we're just rents flatline versus coming down. And I look at all the folks who are like operating with infrastructure and experience and the connections in some of the markets you're talking about, where we've had a little bit more of a whiplash effect where rents went crazy and then they came down. Seems like there's a lot of opportunity, and this is the most vague comment I can make, a lot of opportunity relative to a little bit more distress from folks who maybe bought and got a little out over their skis in those 2019 to 2022 timeframe. Is that a dynamic that you've noticed in terms of like maybe closer to Nashville, where maybe there's been a little bit more high growth, rents fall, somebody got out, bought something at a little higher price, and you're starting to see some stuff sell at significant discounts to maybe where it traded a few years ago? Like, is that a dynamic you're seeing in the markets that you're buying in Middle Tennessee there, or not quite?
Bit, let's say, not as prolific as many stated it was going to be, right? So you see a little bit of it in Nashville, and you hear it in some of the other markets out there that are not really our core markets, but just what you're watching out there. But time again is relative on all parts. We've brought 2 properties from people that have had the property since they built it, right? We just brought a property in Chattanooga and a property up here. Guy built it in 1980, and then the other one, the family built it in 1985, right? And they had it forever, and it was just their time to sell. Right. Yeah. And just so happens it was now. Right. But when you have that person, they're not paying attention to the pulse in the market. They're saying, oh, that sounds like a great number, I'm going to kill it. Right. But it's at a very attractive basis for us. But we did brought a property about a year and a half ago from a group that had to sell, not so much because of the property we were buying, but because they needed to capital infuse on another project. Right. And so that was prevalent at that time. So we did have that, and that gave us a very good negotiation tactic, right, to be able to get that property at a very attractive price. So there is that out there, but you see all sides of the coins. Like if you're on social media enough, it's like, tomorrow the world's going to turn over and you're going to have 4,000 people living under a bridge, right? You never know
Yeah, exactly.
kind of where you're going, right? And so yes, there's the stress out there. I don't know, I'm sure not all of it gets talked about, right? But there's just some markets that have tough times, right? And that's just part of the narrative, right? When you go through this. But I would think that maybe we'll see what happens in going into this 2026, because we'll be interested. We start to see rent relief, rate relief, like it potentially was mentioned in a week ago. If we start to see that in September and that goes and filters into, another one, October, December, I don't know how much that changes. Like if it's like because we're pretty elevated right now, but you look back historically and you look at prime's 7.25, right, or seven and a quarter. It's historically at like 5.5, five, so 5.5, 6. So you figure like the mean, like that's where we're going to end up eventually. It just is that a year from now? Like when is that? We don't know. So
Yeah.
ideally, if you continue to focus on the operations, right? Put yourself in position with, we've been doing a lot of bank debt. We have some agency loans, but bank debt, because it gives you like a 5-year runway, a fixed term debt. That felt good to do because we really didn't have really any exposure to floating rate debt. It just was a decision we made that paid off. And, but the hard thing, if you look historically on a rolling 10-year average, the people who invested in we'll say variable rate debt always outperform fixed rate debt. So if you looked at the part of the metrics of saying, okay, why did they do that? If you looked at, the cost, because typically the fixed rate debt has the cost priced into it, right? Because it's fixed, right? The variable, you're getting a discount. And typically we've never seen this rise in rates like we did, right? So you look at it and I see why people could forecast it, because who would have known that you would see, a massive amount of rate increases in just such a short, dramatic amount of time. But if you go back and again look at the past, we also see rates fall off a cliff when they do start dropping. But we've had a couple rate drops or rate decreases, and we haven't seen much follow.
Love it, man. Nothing to add to that. I mean, that was what a great way to end the show. A lot of great takeaways there for folks to chew on as well as they're thinking about, how am I going to make decisions in regards to investing, whether it's market, whether it's, I mean, we touched on financing a little bit at the end there too. I mean, I could probably dive into that at a whole wild level too, in terms of like fixing versus floating. It's an interesting conversation. It's like, yeah, you're right. Historically speaking, floating is the better financial decision, but everyone's so friggin' scarred from floating their rates that like most people just don't even want to emotionally go down that road. And most LPs look at a deal that maybe has a floating rate attached to the loan, or that's the term of the loan, and they're just getting a little bit nervous knowing how many deals folks were in that didn't go well with floating rate debt. So whole interesting conversation there. But
Question would be
Jason,
today,
yeah.
like if you're a betting man, right? Is the decision that like you look at it and like we haven't gone down that path, but I have thought about it. I'm like, floating rate debt right now seems pretty interesting. Where's the level of risk versus reward?
There is some aspect to you can kind of have your cake and eat it too if you're working with a local bank where you can fix your rate with pretty minimal prepaid penalties, right? Like fixing
100%.
with an agency is that's a decision that's hard to undo, right? Because you're going to be facing significant penalties when you go to refi, regardless of whether you got some type of prepay structure or yield maintenance. But with a
Mhm.
local bank, it's like, yeah, maybe I'll give you a higher rate, but you hit me with a 3-2-1-0-0 step down over my 5 years or whatever. And you've got some pretty good flexibility there.
Great.
But Jason, this was great, man. Where can folks find more about or learn more about what you got going on and find out more about you?
Thank you for having me on. Great conversation. You can go over to yarusiholdings.com, YARUSI holdings.com. Find out all about our company if you want to talk about investments. I have a short form podcast called Live 100 Podcast, talk a lot about self-development that you can find us at and all the other social media ways that you find podcasts.
Love it, man. Thanks again.
Thank you.